Welcome to our channel. Today we're diving into the world of investing and showing you how to get started today. You see, investing is like planting a tree. The best time to start was 20 years ago, but the second best time is right now. Whether you're a complete beginner or just looking to brush up on the basics, this video is for you. We'll break down complex concepts into easy-to-understand language and provide you with actionable steps to begin your investing journey. Brought to you from the desk of Value Creation 6505 on YouTube. Press the like button, share and subscribe to the channel if you haven't. Let's talk about compound interest. Seriously, this concept is like magic. It's the principle of earning interest on your interest, and it's the key to building long-term wealth. Imagine this. You invest $1,000 today and earn a 10% return. Next year you'll have $1,100. But here's where it gets interesting. The following year, you're not just earning 10% on your initial $1,000, you're earning 10% on $1,100 and so on. Over time, this snowball effect can lead to exponential growth. Let's say you're 25 years old and start investing $500 a month in a low-cost index fund that historically returns around 8% per year. By the time you retire at 65, you would have invested a total of $240,000. But because of compound interest, your investment would have grown to over $1.5 million. Now imagine if you had started investing that same $500 a month when you were just 18. By the time you're 65, your investment would have ballooned to over $3.1 million. That's the power of starting early. Even small contributions made consistently over time can lead to significant wealth accumulation. Starting early also gives you a psychological edge, allowing you to ride out market fluctuations and benefit from long-term growth. So, my message to you is clear: don't wait to get started with investing. Now that you understand the importance of starting early, let's dive into the different types of investments you can consider. First up, we have stocks. Think of stocks as tiny pieces of ownership in publicly traded companies. When you buy a stock, you're essentially buying a small slice of that company. Stocks offer the potential for high returns, but they also come with higher risks compared to other asset classes. Next, we have bonds. Bonds are like loans that you give to governments or corporations. When you buy a bond, you're essentially lending money to the issuer in exchange for regular interest payments and the return of your principal investment at maturity. Bonds are generally considered less risky than stocks, but also offer lower potential returns. Now let's talk about mutual funds. Mutual funds are like baskets of stocks or bonds managed by professional fund managers. When you invest in a mutual fund, you're pooling your money with other investors to buy a diversified portfolio of assets. Finally, we have exchange-traded funds, or ETFs. ETFs are similar to mutual funds in that they track a specific index, sector, or asset class, but are traded on stock exchanges like individual stocks. A well-diversified portfolio typically includes a mix of different asset classes to balance risk and return. In the world of investing, there's an undeniable relationship between risk and return. Simply put, higher potential returns usually come with higher risks, and vice versa. Think of it like a roller coaster. The higher you climb, the more thrilling the ride, but also the greater the potential for a stomach-churning drop. Your risk tolerance is your ability and willingness to stomach potential losses in pursuit of higher returns. It's a personal thing, influenced by factors like your age, financial situation, investment goals, and even your personality. If you're young and investing for the long term, you might have a higher risk tolerance. You have more time to recover from market downturns and can afford to take on more volatile investments. On the other hand, if you're nearing retirement, you'll likely have a lower risk tolerance and might opt for more conservative investments. Understanding your risk tolerance is crucial for making sound investment decisions. Let's talk about diversification, one of the most fundamental concepts in investing. In a nutshell, diversification means not putting all your eggs in one basket. Instead of investing all your money in a single stock, bond, or asset class, you spread your investments across a variety of assets. Why is diversification so important? Well, it helps to reduce your overall risk. Think about it. If you invest all your money in a single company and that company goes bankrupt, you could lose everything. But if you spread your investments across different companies, industries, and asset classes, the poor performance of one investment is less likely to tank your entire portfolio. Diversification is like building a strong, stable foundation for your financial future. It's about creating a portfolio that can withstand market storms and keep you on track to reach your financial goals. You can diversify across different asset classes, such as stocks, bonds, real estate, and commodities. You can diversify within asset classes by investing in different sectors, industries, and geographic regions. Remember, diversification is not a one-time event. It's an ongoing process. Regularly review and rebalance your portfolio to ensure it remains aligned with your evolving needs and objectives. Now you might be thinking, this is all great, but I don't have a lot of money to invest right now. And you know what? That's perfectly okay. You don't need to be wealthy to start investing. In fact, you can start investing with as little as a few dollars. One of the easiest and most accessible ways to start investing with little money is through robo-advisors. Robo-advisors are automated investment platforms that use algorithms to create and manage a diversified portfolio for you based on your risk tolerance, financial goals, and time horizon. They typically have low account minimums, sometimes as low as $5, making them an excellent option for beginners. Another option is to use micro-investing apps. These apps allow you to invest your spare change by rounding up your everyday purchases to the nearest dollar and investing the difference. Remember, the most important thing is to start investing early and consistently, even if it's with a small amount of money. Thanks for watching. If you found this video helpful, make sure to give it a thumbs up and subscribe to our channel for more investing tips and advice. Remember, investing is a journey, not a sprint. It's about making informed decisions, staying disciplined, and focusing on the long term. Leave a comment below if you have any questions or topics you'd like us to cover in future videos. And until next time, happy investing. Brought to you from the desk of Value Creation 6505 on YouTube. Thank you.